Hello, I'm Tamara Cook, CEO of FSD Kenya, and it's my pleasure to welcome you to the 8th FSD lecture. That is FSD lecture, and we're delighted to have sign language interpretation for the first time this year. FSD Kenya's annual lecture seeks to raise the discourse about how the financial sector can deliver impact for low-income women, micro and small enterprises, and contribute to a greener, more inclusive digital economy. From our first lecture in 2015, delivered by Dr. Tavneet Suri, and joined by then Central Bank Governor Njuguna Ndungu, discussing the evidence of impact from mobile money, to the 2017 lecture, delivered by Dr. John Kay, and joined by the current Central Bank Governor, Patrick Njoroge, to apply the lessons from the financial crisis to the responsibility of managing other people's money, to Dr. Julie Zolman's 2020 lecture and launch of the Living on Little book, based on the Kenya Financial Diaries, to last year's lecture, delivered by Professor Bitange Ndemo, now Kenya's ambassador to Belgium and the European Union, on digitalization, emerging economic development models in Africa, and the role of fintech. And yes, this is a not-so-subtle encouragement to watch or rewatch all 7 previous lectures to help challenge your thinking and vision for #inclusive finance. Not only will the lectures themselves inspire, but each lecture, including today's, is followed by an engaging panel of public and private sector industry experts to spur the conversation and consider the implications for Kenya. As we were considering what to address in the 2022 FSD lecture, we quickly landed on sustainable finance, a topic that not only elevates the critical issues of inclusion for women and micro and small enterprises, but also amplifies the need for us to consider the implications of climate change and environmental protection. Not only is the United Nations Climate Change Conference, COP27, taking place on the African continent next month, but more importantly, Kenya's most vulnerable citizens are increasingly facing the consequences of climate change and the environment degradation on their farms, their herds, in their forests, and across their communities. Once we had landed on the topic, the ideal speaker was obvious. And we were delighted that Sanda Ojiambo, Assistant Secretary-General and CEO of the United Nations Global Compact, accepted our invitation. Our speaker for FSD Kenya's 8th annual lecture leads the work of mobilizing a global movement of sustainable companies and stakeholders to normalize businesses operating in ways that at a minimum meet fundamental responsibilities in the areas of human rights, labor, environment, and anti-corruption. She's responsible for leading the world's largest corporate sustainability initiative, building the strategic partnerships needed to drive impact and advocacy at local and global levels, driving initiatives such as Uniting Business, Unstoppable Africa, and Good for Business, among others. Her work also involves advising the Secretary-General and the Deputy Secretary-General of the United Nations on the contributions of the private sector to the 2030 Agenda for Sustainable Development, on the engagement of the United Nations with business, and on key organizational partnerships with the private sector. I first had the honor of meeting you when you were at Safaricom at the launch of a pay-as-you-go solar solution, quite relevant to today's topic. It is our pleasure to welcome you to deliver FSD Kenya's 8th #FSD, oh gosh, I got that wrong, guys, FSD's lecture, The Role of Sustainable Finance in Strengthening the Private Sector in Africa. We're also joined here in person by our panelists who will join the discussion moderated by our senior economist, Ansetse Wari. Please join me in welcoming Sanda to the virtual podium. Thank you.
Well, thank you so very much. And thank you also for that really warm welcome. It's such a pity I'm not able to join you in person, but truly appreciate the opportunity to join virtually. And greetings to the rest of the panelists there. So dear friends, dear colleagues, and distinguished guests, I'm really pleased to talk to you today about sustainable finance and how it can strengthen Africa's private sector. It's a truly timely topic, because just last month, on the margins of the United Nations General Assembly, we convened the Global Africa Business Initiative. This was a forum where business leaders, public figures, investors shared insight on the sustainable economic growth prospects for Africa, including strategies for unlocking the continent's financial sector. And looking forward to COP27 in Egypt next month, it is more important than ever now to examine how global financial realities impact both the challenges and the opportunities for Africa's private sector growth, and indeed for that green transition. So over the next 10 minutes, I'd like to talk about the role of the business community in sustainable development and highlight, I think, some of the specific challenges and opportunities for scaling sustainable finance on the African continent. There's three opportunity areas that I'd like to highlight. The first is the potential for impact-seeking investors. The second is public-private partnerships for blended finance. And the third, because I'm here, is I'd like to talk a little bit about the UN Global Compact initiatives to further this cause. So to kick off, ladies and gentlemen, the path chosen by today's private sector leaders will truly determine the well-being of future generations on the continent. Now more than ever, business leaders are making very important economic, environmental, and social decisions. But as we gather today, we all know the 2030 Agenda for Sustainable Development is in grave danger. Unprecedented global crises, climate change, COVID-19, and conflicts, the three Cs, are raging around the world, north, south, rich, poor, and steadily eroding the development advances that we have collectively achieved over the past 2 decades. The reality is that we're never going to be able to reach the Sustainable Development Goals without substantial private sector investment and the mobilization of financial markets. But to date, private investment to support sustainable development, especially in the Global South, has been vastly insufficient. The good news, though, is that while Africa is facing many of these daunting realities, indeed, as is the rest of the world, the African continent is also best positioned to be the most important driver of global business and a leader in sustainable finance. With a $2.5 trillion market opportunity, every single sector of Africa's economy can and should be on a growth trajectory, from manufacturing to agriculture, from services to finance. The Africa Continental Free Trade Area Agreement is poised to accelerate investment opportunities within the continent as well as the world. And with our vibrant, youthful population, by 2050, 1 in 4 people in the world will be African. And this offers up a massive consumer and business and investment market. Let me reflect on Kenya for a little bit. Kenya, one of the leading and fastest growing economies in sub-Saharan Africa, serving as a financial and logistical hub of East Africa and beyond. In 2022, the Global Innovation Index ranked Kenya in the top 5 innovative countries on the continent. We know the Kenyan economy grew by 6.7% in 2021 after contraction, but growth was driven by services on the supply side and by private consumption on the demand side, both benefiting from the policies and the eased COVID-19 restrictions. Nevertheless, statistics tell us that inflation climbed to 6.1%, up from 5.3% in 2020. First, let me also applaud Kenya for holding peaceful elections recently, which was followed by a peaceful transition. All of these are great signals for investors and for business. And this is a true measure of progress to enhance the prospects of economic growth. However, I think also the projections are that growth will decelerate slightly and driven by a decline in domestic and external demand, caused by lower income and an increase in food and fuel import prices, factors that are being felt all around the world. So Africa's growth is indeed unstoppable, and we must also ensure that it's sustainable. We all know that the private sector is so central to the ecosystem of sustainable development. First, businesses naturally must make direct investments in the economy and the society. And when a company's activities are aligned with sustainable practices, they also contribute to local and national development goals. We see that every day here at the Global Compact. In addition, companies can leverage their contribution to the broader goals, the SDGs, to raise financing from impact-seeking investors. Impact funding can then be used to make further investments in economic and social development locally. This is a form indeed of financial intermediation. That is, channeling funds between parties in ways that create efficient markets and lower the costs of doing business. Intermediation is especially important in emerging markets where higher risks and perhaps slower economic development can prevent other types of capital investments, including portfolio investments. Friends, it's clear now how financial intermediation can strengthen both African businesses and communities. But it's also important to acknowledge the challenges to scaling this type of foreign investment. Foreign direct investments, or FDI, as we know, was severely reduced globally during the COVID-19 pandemic in Africa and, of course, around the world. In 2021, FDI in Africa has rebounded, but only still accounts for about 5.2% of the global FDI, according to UNCTAD. Furthermore, this improvement, though upwards, was uneven, both throughout the continent and across sectors and across industries. The majority of foreign investment flow to the majority of investments flew to natural resource and extractive industries, often failing to consider infrastructure that addresses the public good, such as health, services, roads, or water. So lack of foreign investment for infrastructure and other sustainable development initiatives can often be traced to three risks, and they most concern foreign investors. The first is project risk. And in spite of Africa's burgeoning potential for sustainable finance, we often hear people say that the number of large-scale investment-ready projects remains limited. The second is currency risk and exit risk. These two also scare away potential investors in many economies. To address these risks, we need very strong political and business leadership working in tandem together towards creating favorable internal and solid policy frameworks. The challenges before us may be clear, but alongside each roadblock, there also lies an opportunity for sustainable and inclusive private sector growth. But where does this potential lie? To start, the African continent has huge potential to move away from fossil fuels and drive the renewable energy transition. Already very green, but lots more potential. And as global temperatures rise, impact-seeking investors are especially motivated to invest in the green economy. The continent boasts significant solar, wind, hydro, and geothermal energy sources that could create more than 6 million new jobs by 2050. But despite this picture and a good lead-in to COP27, Africa only received 2% of global investment in renewables over the past decade. Looking onwards, now is truly the time for innovation and increased public-private partnerships to make investments in African renewables much more attractive. Another area that presents both challenges and opportunities for sustainable financing is the continent's small and medium enterprise sector. In Africa, as we know, SMEs make up the vast majority of businesses, 44 million in sub-Saharan Africa alone, and provide an estimated 80% of jobs across the continent. Women own at least 40% of Africa SMEs, but receive only about 1% of venture capital funds. Yet these women-owned, women-led enterprises play such an important role in development. They usually hire locally, they reinvest profits in resources that benefit families and communities, and they make their projects particularly attractive to impact-focused investment. So ladies and gentlemen, when businesses can increase their environmental, social, and governance commitments, corporate investments can provide a pathway between portfolio investors and SDG investments that are otherwise too small, too risky, or seen as illiquid. And along these lines, development finance institutions are increasingly working with the private sector to encourage critical corporate investments in emerging markets. The Global Investors for Sustainable Development Alliance, or GISD, which is an initiative housed within the UN, is developing a sustainable infrastructure investment platform. This blended finance structure was created to co-fund sustainable infrastructure in emerging markets and developing economies. At this time, I'd also like to share some of the efforts within the UN Global Compact as we work to build new public-private partnerships for sustainable finance. These efforts include subsidized corporate finance, a form of blended finance where a public entity or development institution provides guarantees or other financial benefits to a company or a bank to support sustainable development. Subsidized corporate finance harnesses the benefits of corporate and financial intermediation by real economy companies and banks to maximize the use of public funds. The UN Global Compact's CFO Coalition for the Sustainable Development Goals is taking a leading role in setting and aligning sustainability and financial targets. Together, we're working to create a $10 trillion market for SDG-directed finance by 2030. We know that sustainable financing is the only way to effectively realize the global goals and the African Union's Agenda 2063. A little bit about the UN Global Compact's Africa strategy, which aims to scale business impact and deliver the SDGs through accountable companies and practices that align with our 10 principles on human rights, labor, the environment, and anti-corruption, offering businesses a roadmap not only for responsible business, but also business practices to increase competitiveness and further sustainable development. As we look forward to COP27 in Egypt just next month, we know that sustainable financing must no longer be treated as a niche practice, but as our only chance to create a more prosperous and inclusive future for the African continent and indeed worldwide. We also know how to solve so many of the problems before us. And from a global financial perspective, there is no shortage of capital. What we must do better is to leverage this capital to strengthen our continent's private sector growth and make a very long-term investment in our humanity. Thank you very much.
Thank you very much, Sanda Ojiambo, Assistant Secretary-General and CEO of Global Compact. I think there was a lot of thought-provoking and exciting content that you shared. And I think what we would like to do now is allow our panelists who have joined us to engage with you a bit further and also ask any questions or comments that they may have. So joined with me today, I have Dr. Habil Olaka. He's the CEO of the Kenya Bankers Association. We're also joined by Eva Warigia, the CEO of the East Africa Venture Capital Association. And finally, we're joined by Samir Ibrahim, who is the CEO and co-founder of SunCulture. I think, Samir, I'll start with you to sort of give you feedback and have any questions or comments for Sanda. Go ahead, Samir.
Thank you so much. And nice to see you, Sanda. I think we spoke every day for a couple of months at the beginning of the pandemic, so nice to see you here virtually. I mean, you've sat in both the public and the private sector, and my feeling is that for some of these big problems around agriculture or energy, we know what works and we know what we need to do. My guess, for example, is that it would cost somewhere under $500 million US to solve food security in Kenya. What will it take, in your view, to start mobilizing this type of capital and start deploying in the time that we need? Because we're very quickly running out of time.
Absolutely, and thanks, Samir, and really great to see you again after a couple of years. And, you're right. As I said in my comments, I think, there is no shortage of capital. What we probably need to do a lot better is a couple of things. First, I think we just need to look at what the de-risking environment is, both internationally as well as what do we need to do to be able to create those, the synergies, the opportunities for financing to come together, both from an internal domestic capital perspective, as well as any international financial capital we need to mobilize. I alluded to one other issue within my comments, which was the perception, and I leave it as perception, that there's not enough bankable investor-ready projects. I think that collectively, we need to do, better or find ways in which we can really just profile what exists as investment opportunities on the African continent a lot better. I know that they do exist. My question is, do we need to find the right platforms to put them out there? Are we having the right conversations? Are we bringing the right stakeholders around the table? Samir, for me, the situation is not a grim one. It's one of fixing, things that will make us partner better and sit around the table better. We have the capital. We certainly have the innovation. And I think we have the goodwill. So for me, the picture is one where, we just need to figure out how to get us all around the table and solve these problems collectively. It's one where, as you alluded to, I think the public-private partnership, the speaking the same vocabulary, understanding the problem from the same area, but most importantly now, putting on that layer of urgency that we need to solve problems is really critical.
Wonderful. Thank you, Sanda. And I'll hand over to Eva for your comments.
Nice to see you, Sanda. Now, I represent private capital, and like you alluded in your comments, there really is no shortage of private capital here. My question to you is around impact measurement, especially for investments in Africa. We are often left to measure our impact based on some of the measurements or matrices that are defined perhaps outside of the continent. If you think of carbon footprint measurement, and this may not always be practical for the African continent where there are more visible needs. Is there room to customize the impact measurements, and what is UN Global Compact doing to ensure that what we measure in Africa is that which is relevant, so that even as we attract impact capital onto this continent, we are aware that we are measuring based on a yardstick that is relatable to the local person?
That's a really great question. Just last month, we convened the Global Africa Business Initiative here in New York. And, one of the things that we acknowledged was it's truly the time to reset Africa's narrative. And in that reset, it doesn't mean any shortage of ambition. It's actually driving our ambition forward, driving priorities forward, but through the lens that makes sense for African-led, African-driven investment and growth opportunities. So by all means, I do firmly believe that success measures around the world can never be the same. This is not a one-size-fits-all, growth trajectory for the various regions of the world. The one thing that I do feel sitting here in the UN is that the Sustainable Development Goals provide an excellent framework to measure and assess progress globally. But if you dig into the goals, the targets then become applicable to regions in various ways. And I fully agree with you, picking on the climate angle. The simple, the mere climate debate can be sliced and diced and approached from very many angles. Depending on where you sit in the world, perhaps your focus is on mitigation and, reducing emissions in heavy emitting high industry companies. If you sit on the other side of the world, if you're sitting, for example, in one of the small island developing states, it's a mere fact of survival. How do you adapt and make economies a lot more resilient to climate shocks? In other areas of the world, it's about how do we invest more in renewables? So I think there is really the opportunity to first of all, actually shape the narrative, shape the projects and the success you desire from a perspective that makes sense. Speak to the investor in the language that will give them the ROI that they're looking for. And then, as you said, yes, we can tailor your success outcomes, in the way that makes sense. The SDGs provide that perfect framework with the 17 goals and the 169 targets. There is room in there to address any angle, any problem, any project from any angle.
Wonderful. Thank you so much for that response. And then finally, I'll hand over to you, Dr. Habil.
Yeah, thank you, Sanda. That was a very thought-provoking presentation. I must say that there's quite a bit of bits that I've picked from there, which have really provoked me. Now, I come from the banking sector, and certainly the benefits of sustainable finance are not completely foreign to us. I think they have become quite clear for us. I think the challenge we are having is the fact that our performance metrics, our measurement of deliverables is still very short term. So we tend to look at the immediate gain, the immediate profits. So it's easier for me, for example, to fund a carbon fuel project as opposed to the alternative of going for the renewable energy. And I think you mentioned quite a bit of indicators of how endowed we are in Kenya in terms of the renewable energy resources. But the way we have structured our metrics is such that it's easier for me to go for a carbon fuel project compared to renewable energy. Now, I don't know if you can give us some tidbits in terms of how should we start changing this conversation so that you can have, for example, the banking sector moving towards sustainable finance as opposed to the traditional, conventional, non-sustainable alternatives.
Thank you, Habil. Again, also good to see you, and congratulations on the continued work that the Kenya Bankers Association does in terms of the banking sector as a whole. Your question is, I think, the CEO's age-old conundrum, which is, first let me talk about the statistic. Just about a year or two ago, it was estimated that the average tenure of a CEO in office is 3 to 4 years. Yet here we are talking about these long-term needs for humanity, long-term investments that span 20, 30 and beyond. So I think the first question when entering office is, what am I here to do? And I think it's the mind frame. The first is a huge mind shift around what is the role of a CEO, what is the role of a board? And it is a true dilemma. Are you here to make decisions that will see your company profit and address its various stakeholders and shareholders in a 3 to 4 to 7 year horizon? Or are you here to really make transformation for your company, for the industry, and perhaps for society? Now, not to be too esoteric in response, I think, the challenges that we're all facing globally at this point in time would behoove, I think, a CEO and a board to really be able to sit down and start making a few of those longer term decisions, because at the end of the day, irrespective of where your company sits, presumably you're relying on natural resources, you're relying on human labor, human inputs, you're relying on technology, you're relying on regional or global cooperation, you're relying on a workforce that is predictable, you're relying on a currency and an economic environment that is predictable. So I think that really puts the need for both short and long-term decision making in process. And it is not easy. I think, if I was to have this conversation with any company, and I certainly did work in, Safaricom a few years ago, I think some of the decisions that were made at board level was, how do you balance some of the long-term strategic investments? So for example, if you're working in an industry that does require energy sources, how do you begin a shift of shifting your energy mix and slowly transitioning out of perhaps, less renewable to longer term renewable resources? How do you transition some of your technologies from short-term solutions to longer term solutions? So I would first say, I think commitment needs to start at the board level. Secondly, it will be a transitioned approach. And I think the earlier businesses can get into making some of these transitions for a long-term future, the better and the easier it is. But I think one of the key things also is to see how to address investor interest, because I think that is also one of the bigger pressures. You have investors who are interested in short-term gains versus long-term gains. That's where impact investing, I think, needs to take a much bigger hold into some of these important investments that not only shape our economies, but shape our future. So Habil, a multiple of factors that need to come in, both from the CEO level, the board level, but also I think looking more at how we can get impact-led, more longer-term focused investors engaged in some of the businesses that we do. Most businesses, if not all, will have an impact on our common future. I think the idea, and most importantly, is to see how much that business itself recognizes the short-term impact that it has by term decision making.
Thank you so much, Sanda. And I think I do have one question for you. As we're going into COP27, this is Africa's COP, all eyes on Africa and the African private sector. Mine is a very easy one. Particularly for the private sector that will be at COP, that will have a platform. What's your message for them in terms of really anchoring in and scaling sustainable finance in a manner that matters to us?
Couple of things, and really excited to be going actually in a couple of weeks to COP. Let me just say that, one of the things that we've done this year that has been truly remarkable is to bring together a coalition of African business leaders under the Africa Business Leaders Coalition. It's the first time continentally that a contingent of leading African businesses is coming together with a united message about Africa's the private sector's role in climate and solving the climate crisis. What I think for me a key message would be is first the recognition that the private sector does play a role in addressing the climate crisis. There's no nationally determined goals or policies that will be set without understanding the very important role that the private sector plays. If I was to give one message, it would be to any government to bring the private sector around the table as they're determining their climate plans and their NDCs. They're never going to make that transition without the private sector. But by bringing the private sector to the table, what are the incentives? What's the enabling environment that they're creating to enable true and engaged private sector participation? I think for me, those would be the two. So come to the table, but also let's look at what is the enabling policy environment you need.
Thank you so much, Sanda. It's been such a pleasure to see you, and I think everybody on the panel has had the privilege of engaging with you before and today, and we will continue to take sight of your conversation and your insights as we have the discussion here. Thank you so much for your time. And I think I'll start with you, Samir. Of course, you're the CEO of a sustainable business. You founded it with sustainability in mind. And I just have to ask, people are acting like COVID is over. I know a lot of people in Kenya, it's like that's behind us. But first of all, tell us a bit about SunCulture, because it is a sustainable business. So what does that actually mean in Kenya and in Africa? But also I'd like to understand, how did COVID affect you? How did COVID affect your clients? How did it change their financial expectations and what they expected of you? And how did you pivot?
So working in sustainability in these markets does not differ necessarily from working commercially, because a lot of opportunities commercially are within the sustainability lens. So the lens that we take is that climate change disproportionately affects those who are the least contributors to it, who happen to be smallholder farmers in emerging markets. And we work at the intersection of how climate is affecting their resilience from a food production perspective, from a political stability perspective, and from an economic perspective. So we make, sell, finance, and service solar-powered irrigation systems, and then on-sell additional goods and services. So we use consumer lending and carbon revenues to make the cost of solar irrigation less than that of diesel and petrol pumps. Now, COVID made, and yes, COVID is still going on, still a pandemic. COVID made what we're doing more important because supply chains were choked. Smallholder farmers contribute to 30% of the food that we eat globally. And the amount of climate resilience required at a community level was enhanced massively. There was a survey that was done in Kenya that found that about 90% of smallholder farmers in country lost money during the pandemic, which seems obvious, sort of looking backwards. Almost the same percentage of our customers made money. 96% of our customers reported improving their quality of life. So we see an incredible amount of impact that can be done from a private sector solution. That being said, it got harder, right? You have supply chain constraints, so cost of goods have gone up. You have a strengthening US dollar, so cost of capital goes up. We lend to our consumers in Kenyan shillings. You have the inflationary aspects of Russia's invasion of Ukraine. You have cost of core goods like fertilizer and oil going up because of the war in Ukraine as well. So our margins are suffering. But what do? Do we increase prices? At the same time, our customers are suffering. So we've had to engage in other activities to help us figure out how we can reduce our price. So we've engaged in launching our carbon business. We're lobbying for results-based financing because what we have seen is that consumer confidence has dropped massively. The ability to repay at the beginning days of the pandemic was very, very low. We actually structured a guarantee facility with FSD Kenya and with Alpha Mundi to help us relaunch our credit facility. And since then, we've seen that repayments have not suffered. So we feel very good about that. But at the end of the day, cash is very low and people are quite suffering. So it's this balance between what is our fiduciary responsibility to our investors and to our shareholders, and what is our moral obligation as a company working in sustainability, and how do you balance that? And I think sustainable finance plays a role in there. It's not perfect, but there's certainly this conversation will maybe uncover some of that.
Thank you. And I think that's exactly what we've seen, and I think Sanda alluded to that before, is that we see this appetite to invest, but then on the ground, the nitty-gritty of actually getting it done gets quite difficult, and that's why I want to bring you in, Eva. Obviously, you're sitting at the nexus of venture capital, and we've seen, particularly after COVID into 2021, 2022, this real appetite and wave of startup financing, particularly into tech, with Kenya being one of the main 4 anchor investor countries. I mean, first of all, I'd like to understand what is really driving that appetite, really, and also what are the sustainability requirements that wave of capital has?
So just for context, Africa, when the rest of the world was experiencing a crunch in venture investing, Africa surpassed its momentum, and we have data suggesting that we crossed the 3 billion fundraising mark in June of this year, relative to last year where we crossed 3 billion in startup fundraising in September. So we have a 3-month lead. On average to date, we've had a 133% year-on-year growth on venture fundraising in Africa alone. And this then demystifies the notion that Africa is a risky place to invest, that Africa does not generate returns for commercial venture lenders or private equity investors. And there is a lot of interest here. One of the things is what Samir has alluded to. It is possible to do impact and make money. And for many of our investors, they're realizing that there's a lot of growth opportunities here. There's a lot of opportunity for transformation, and importantly, they are investing in businesses that people care about. It's not about gamification of this or that. We are not creating the next toy. We are really backing businesses that transform lives, like SunCulture is doing, and for that it makes an easier case to make investment into the continent. So what are some of the requirements that we're looking at? Obviously, growth and scale, it's still a market that very much needs capital to support any growth strategies across the board, from technology, renewable energies, and even traditional industries. So supporting scale is one, and scale that is backed by local fundamentals. So this notion of perpetually fundraising, so we're trying to move away from that, and how do we build businesses that can stand on their own 2 feet? So that's one. And then the second one is formalization of business. So for many of the companies, maybe in part because they're younger, there's not enough structures put in place, even within ecosystem level. We don't have policymakers who understand what venture is doing. We don't have registration of business that is dedicated to early startups. So creating formal structures, and that's a place where the EAVC is taking part in, being very active in advocacy, in building the policy framework, just to create an enabling environment. So from a level of, say, governance, it's around formalization of businesses. It's about introducing the impact matrices that Sanda talked about, because there is a convergence of global dialogue around sustainability. And as a business is coming up, there's need to look at how do they fit in that global agenda. So introducing these ESG matrices through impact investing and impact measurements that venture and PE does rather well in terms of reporting. And then the other bit that we are very active on is in social sustainability and inclusivity. So gender lens investing is a big thing in venture, trying to create funds dedicated to women empowerment or women-backed or businesses that have women as the leading consumer. Beyond gender is inclusivity of local founders, so that we create a pool of entrepreneurs that come from Africa, are building Africa for an African consumer. So that's the other big push that we're seeing in sustainability, inclusivity. And the last one is environment, and I won't touch much on that because Samir has alluded to it, but also how do we conserve the resources that we have on the continent. And we have a lot more climate financing that is coming up, and increasingly we're introducing climate innovation matrices towards financing. So are you able to raise money not through the traditional fundraising sources, but can you trade some of your carbon credits as an avenue to raise capital? And there's venture experts who are helping startups on this continent to do that.
That's wonderful. That sounds like the diversification that I think Samir alluded to. And so now I just want to turn to you, Habil, because obviously you're leading the Banking Sector Association, and I'd really like to understand, you mentioned some of the tensions in the comment you had with Sanda, but what is the banking sector's understanding of sustainable finance, and how does that understanding intersect with what you had said, the drive to profit, the drive to financial sustainability? What are the synergies that you're seeing, but also what are the tensions there? Because sometimes on the ground we're not clear on that.
Yeah, thank you very much. I think maybe just as a background, what do banks do? Banks do financial intermediation. So they get money from depositors in terms of savings, and they allocate them to projects that need the funding. That financial intermediation is done at a profit. So you have got to be profitable, do it with a financial return in mind. But for those profits to be generated over the long term, they have got to be done sustainably. And therefore you have got to factor in concerns around the environment, concerns around the social well-being, concerns around governance. And so you find that therefore for you to be able to operate profitably well into the future, you've got to factor in sustainability issues so that the whole ecosystem is sustainable going forward. Now, it means therefore that you should practice as an institution sustainable practices, but you should also fund entities that are practicing sustainable practices. And you should also create products that promote sustainability in the market. So it's a whole framework that then puts responsibility on the financial, in this case I'm talking about the banking sector, in terms of supporting the, the sustainability, framework. Now, having said that, I think also banks are quite attuned to the fact that of the SDGs, by the way, 17 of them, I think banks do directly support almost about 5 of them. So it's quite a relevant topic for us. So in other words, banks should do their banking business in a way that they still provide a return for the shareholder, but at the same time, from a profitability standpoint, but also at the same time, they have got to be conscious of addressing the environmental, social, and governance risks within their practice. Then you mentioned about the fact that the tensions and the synergies and the tensions. I think one of the things that comes out quite clearly is that the investors are, I think, looking for investment opportunities for entities that are conscious of the sustainability issue. And therefore, banks are under pressure, for example, to ensure that they also align to sustainability for them to attract the investors, the right kind of investors into the institution. And so the investors are continuously looking at the reporting framework of the banks in terms of what they are doing to ensure that they are sustainable going forward in view of the relevance of the topic. So from that perspective, that is the case. So banks also therefore have got to ensure that they make some significant investments in terms of understanding things like climate risk. They have got to ensure that they understand the mitigating measures that they need to put in place to address those climate risks. And then, of course, greening their portfolio to ensure that they are moving towards the transitioning into a green environment. And this can be done through issuing, raising funds through issuances of, capital raising instruments in the market, for which green bonds, of course, are, a very good example. But they're not only green bonds. You've got social bonds. You've got the other alternative capital raising instruments. They also have got to invest significantly in, the climate change mitigation and adaptation activities that therefore, in a way, remove risks from the investments they make, because otherwise you might find yourself having to continuously revalue your assets based on the risks that are developing in the market, and you find yourself having to continuously downplay or discount your asset base to the risk of the ultimate shareholder.
I mean, that's exactly the tension that we've been seeing as we work, obviously, with the banking sector and others, is, sustainability finance is becoming core finance in terms of how private sector conducts itself. And so back to you, Samir. I mean, you've been a sustainable enterprise from the beginning. So how has sustainable finance changed since you started to now? What's increasingly being done right? But also, what do you think can be done better?
So I'll start with what can be done better. Sustainable finance institutions seem to sometimes be confused as to if they actually want companies to succeed. Now, let me explain. We've heard, and I've been observing many, many companies and many transactions, but many sustainable financial institutions are wary of providing companies with too much support. We don't want to help them too much. We want to spread over many, many organizations. And I think the risk here is that there are very few, if any, sustainable companies that have reached any type of scale. Right? We're the largest distributor of solar water pumps for smallholder farmers in Africa, but we're just scratching the surface. I mean, just scratching the surface. So there seems to be this confusion as to sort of how much help is required.
What do you mean by help? Do you mean investing, or what do you mean?
All types of capital.
Okay.
So I think, this phone was funded on grants. I know subsidies have a very interesting take in the market, but subsidies, equity, debt, guarantees, all of it is required to build industry. It's worked in all places around the world. Every agriculture, every energy, many technology organizations and industries have been built with many different types of capital. So It's sort of the type of capital required when, sort of is this the help. And I think there's some things that could be done to sort of ease make things a little bit easier and faster. So one is the timelines that it takes to fund it very, very long. I've seen transactions in the market take 1.5 years. I've seen transactions take 2 years. And of course, there's a lot of risk appetite that's changed with the pandemic, naturally. But a lot of these sustainable finance institutions enjoy guarantees and first loss themselves, and we don't see those that put to use. There's also this interesting notion of all of the impact reporting that's required. I very much believe in impact reporting. Our company was founded on the pillars of impactful work. But when you have 3 or 4 lenders, maybe 3 or 4 equity investors, maybe 3 or 4 donors who have their own reports, you very soon find yourself subscribing to every standard available, and every month you're submitting 12 reports. Yeah. It's very, very time consuming. So a lot of time spent servicing the sustainable finance industry versus the sustainable finance industry serving the impact required. So I feel like there's this sort of this switch that needs to happen. I think what's going well is that there are increasingly, as you mentioned, more options for financing. There's a lot of money in the market. I think that's a huge, huge point of progress that I've seen over the last decade. When we were first raising equity in 2017, we had to beg for money. Mm-hmm. Now it's much different now. Mm-hmm. So that's very positive. I think ultimately, even though things have been slow and we've seen in market that sort of the paradigm needs to shift in who services who, people are still investing. Whereas in other markets, maybe investments dried up. As you were mentioning, we've surpassed the amount of funding already by September that we saw in venture in Africa only by last June. So there are people investing. I think that's positive. There are a lot of increasing conversations around the role of subsidies and results-based financing, which has been quite interesting. Yet to see any movement on that, but I think that the blended finance aspect of sort of the conversation has taken shape, and that's quite interesting. And the availability of alternative sources of funding to continue to lower the price of climate assets like the carbon market developing has been very interesting. There's a nonlinear correlation between price and addressable market for many of the solutions that companies are offering to a majority of African consumers. And being able to self-subsidize and being able to lower the price of these products increases addressable market massively. So the consumer market that Sanda was talking about earlier in our comments, I think gets accelerated by the ability to bring in alternative sources of financing. So I think there's a lot of pros. I think there's a lot of work to be done, but overall, quite hopeful.
Yeah, absolutely, and that's what we've seen. There is a premium sometimes, in addition to the bandwidth and the technical skill, that there are other premiums that are attached to sustainable finance. And I think one of the questions I have for you, Eva, is that despite this appetite to lend sustainably, particularly to women, Sanda already alluded to it, you've alluded to it as well, but women enterprises in particular just struggling in terms of really anchoring the type of capital at the scale that they want, to the scale that frankly that they deserve. And what are some of the dynamics informing this really? And how are you, for example, in the ABC addressing that?
Sure. It's rather unfortunate that for Africa, where women are drivers of economies, they receive the least support from the institutionalized or formalized financing. We're hoping to address that, but there's a few reasons. Some of it is legacy, and Dr. Olaka can talk to it from a banking perspective, but the fact that women in many communities can't own collateral is in itself an impediment to accessing, among others, debt. And then after that, you'll find, so what happens with that, even when they have an innovative idea, because the environment doesn't allow them to own that, so even when they do register a business, it's registered under the husband's name. So away from just accessing institutional capital, from the get-go, they register the business as a man's, even though they will be the active investor, or not investor, but rather active brains and innovator entrepreneur around the business. So part of it is, as I have observed, structural failures or a misogynistic society, if I can just be blunt. And from our private capital perspective, the structure is actually, it goes all the way to the top. So we raise money from LPs to deploy into our portfolio companies. At LP level, we don't have enough women in finance sitting around the decision-making table of which GP to allocate capital to. So if you have a team of men in the investment committee making a decision on which fund to give money to, they'll likely fund a fellow man, right? And so, and I have statistics where in Africa, there's less than 1% of women who are raising funds. In East Africa, I only have one fund out of Ethiopia that has a female founder. I have over 100 funds. I have 55 members who are capital allocators in the EAVCA, and there's only just one woman who founded a fund. It takes long to fundraise, and some of us are not risk averse to that extent, but increasingly it's just the hurdles you have to jump as a woman in accessing capital to convince a male committee, sitting somewhere else, often outside the continent, that you are deserving of their capital. So it starts at that level. So if they are deploying to men, guess what? The men were going to look at other men to deploy to, and eventually the portfolios are going to be disadvantaged when it comes to accessing capital. Sanda had a good statistic. Only 1% or less of women in Africa were able to access venture capital funding in 2021. So that's a structural thing. There's also the types of businesses we do are not the cool businesses to invest. And there are cool businesses to invest in, we have found. So tech is increasingly getting a lot more capital. It's easier to fundraise for tech from a VC perspective. Renewable energy, no offense, is another sector. And often these are not sectors that will have a lot of women acting there. If you think of the background, it's a tech engineer. There's going to be a lot more men who are starting funds and then starting portfolio companies. Conversely, and you mentioned the COVID pandemic, a lot of the women businesses that suffered then, and women were some of the biggest actors who were affected during COVID, was because they were in service industries. It's very hard for a service industry to raise capital. Hospitality, tourism, and tours and travel agencies and so forth. It's very hard for them to raise capital. Communication consultants, research consultants. And that also affects the type of capital that goes into them. So how are we addressing that? As EAVCA, we are strong in advocacy. So we identify we have a structural problem in our industry. We go all the way up to the LP level. What can we do to catalyze more funding for women? So there's a few funds, and I think FSD Africa is backing one, where they have created a technical assistance facility dedicated to catalyzing women fund managers. They are only doing support for women fund managers, and hopefully it trickles down to the portfolio. Standard Bank out of South Africa is also doing a similar project where they raised, I think it's $1 million to maybe $10 million to support women fund managers, first-time women fund managers, and they're giving them skills around portfolio management, fundraising, risk assessment, and even ILPA reporting for the fund level. So we identify that it's a structural problem. We've started at the top, talking to our LPs, what can we do to catalyze capital for female GPs? Because female GPs then deploy to women. And then the second is backing gender lens initiatives. 2X is a good success. It was started by DFIs. 5 DFIs committed to backing women and women leading strategies. So seeing how we can sensitize 2X across the region. The first launch of 2X was in 2018 in Rwanda, and they've done a few programs in Africa. Ethiopia, Kenya, and Rwanda have been some of their beneficiaries. And then locally, trying to also work with our own members to integrate and make gender mainstreaming, not a gender lens strategy, but mainstreaming gender, that it has to be a factor you consider from your hiring processes to your investment processes.
Thank you for comment. Something that I think is interesting that you said that we also see at the end consumer level with smallholder farmers is that the customer, the user, is not the payer. Like you said, the innovator is not necessarily the owner when it comes to businesses. We see that a majority of our customers, the people using the system, are women.
Right.
The ones coming up with the idea to purchase the system, women. But the customer from who sends us money, it's the man, because it comes from their M-Pesa account.
Is the man on it, or is
I was going to
he
say,
just
who
the
owns the
registered?
asset? The man.
Exactly. So
Who's
it's
the
who's
registered?
registered, who uses it. It is very, when we've surveyed, and we've worked with 60 Decibels to do deep surveys on this, we find that a majority of the households, independently of the male and female of the household, independently of each other, say that they made a joint decision. More often than not, the woman is the one using the system on a daily basis, but the money gets sent from a man's account. And it just goes back to what you were talking about, just the system that has been set up does not necessarily allow for the innovators or the users, more often than not women, to be the owners of the assets or the businesses that they're creating. And just to kind of hit your point home, even from as ground level as we can get to.
And I'd like to just pull in Dr. Habil on that, because it is something that particularly the development and finance institutions have picked up on. And so a lot of banks in Kenya do receive subsidized green and sustainable money, particularly from development finance players that say, we want you to deepen lending to SMEs, we want you to deepen lending to women, we want you to deepen lending, for example, to green businesses. But often we don't see that showing up in the ecosystem. I think from the conversations we've had and the comments that Sanda made, the segments still complain that they're not getting financing. So really my question is, why is that? Where's that disconnect from? Because there is a supply that's trying to plug that, but on the demand side, we're not seeing it show up.
Yeah, that's a very interesting observation, because normally we are used to the fact that banks will normally give the indication that they don't have the right kind of funding to fund the investment proposal. But I think you have shifted it around, and you're putting it the fact that they have the funding, but they are not lending it out. And I think it comes down to Samir's point about the fact that you find yourself having to make continuous reporting, and you rarely have time to even implement your idea. You are continuously reporting and compliance rather than effectively. But I think the point is that most of the funding, for example, come from the DFI. The DFI will give the bank some very specific conditions in terms of because this is a line of credit, for example, with very specific conditions in terms of performance of the portfolio. Now the bank will have to abide by those conditions and effectively transfer them to the consumers. Now the consumers, the category that you mentioned, I think there are some very specific challenges that we normally notice. One of the biggest barriers to access to credit, especially for that segment you mentioned in terms of the women, the SMEs, and the green enterprises, one of the biggest challenges I think is informality. Informality is a big barrier to access to credit, partly because of the fact that the provider of finance is not able to assess the entity. You're not meeting things like, for example, even basic registration of the business as an entity. It is the business and the individual are almost like one and the same. So you have not quite separated the business from the individual. And that becomes very difficult from a financial perspective to be able to separate the two. The other thing is some basic things like, for example, meeting tax compliance, because that's one way in which the credit provider can be able to assess your compliance. And by compliance means your possible ability to be able to repay the facility. Because at the end of the day, when you give out the money, you expect the money to come back. And some of these conditions you put in place are to just give you some comfort that the money will eventually come back. Because that money, you're going to pay it back to the DFI, if at all it was funded through the DFI. So the critical thing is the fact that, and it's true, the entities you mentioned, the SMEs, the women, and the green enterprises, normally would have challenges because banks will take them through the normal credit appraisal process. And the credit appraisal process, there's something called the 3 C's of credit. You assess the capacity of the project to pay back. So you're looking at the cash flows and the promise of the cash flows, and are they likely to be able to repay back the facility. Then you're looking at the character of the individual. In other words, you may have the capacity to repay, but if your intention from the word go was never to repay, you're not going to pay back, even if you're able to. And the financier needs to be able to assess that, get a hint of the fact that is this person likely to able to pay back. And then something that Eva mentioned was the access to collateral, because it's one of the determinants. In the event that your assessment of this credit facility, in terms of the character, in terms of the capacity to repay, supposing they don't quite turn out to be true, you need to have a fallback position. And that's why you take the collateral, that in the event all these fail, I'll have something to fall back on and be able to recover my money. So, and those particular entities, the SMEs and the women-run entities and the green investments, most of them tend to have challenges on those, especially on the collateral bit of it, because one, they have not been in business for long to build a capital base on which to leverage for purpose of accessing credit. So I think it's true of the fact that there are those challenges, but I think for each one of them, there are a number of things that are being done to try to turn things around. So on the case, for example, collateral, there are a number of alternatives that are coming up in the market. The movable assets collateral registry is now beginning to build up so that you can use alternative assets rather than land and building to be able to access credit. And usually the alternative collateral, most of us have got some form of alternative collateral. You'll have some agricultural assets, you'll have some furniture and fittings, you'll have some equipment in terms of a laptop or something, which you can use as an alternative to accessing collateral. So it's true that the borrowers are having challenges from accessing the funding from the banking sector, but I think those challenges, having been addressed, are being addressed from the point of view that each of the challenges can always be, something can be done about it. So if it's an issue of informality, there are programs of trying to capacity build the SMEs to ensure that they convert from informality to formality, register them, become tax compliant, and then they can now be able to access credit.
Thank you. Yes, and I mean, that's one of the things we've seen is that the incentives to formalize, the incentives to stay informal. But I think what I hear from you is, particularly from the women's perspective, the issue seems to be the cash flow and the collateral, because the character, I think we've seen that women are some of the best borrowers, but it seems like cash flow and collateral trump character. So I'm glad I've learned that. But I think we're going to start wrapping up the panel, and I think I'll just, as you give your final comments, I'll start with you, Samir. First of all, there's a lot of hype on, sustainable finance. As you're saying, there's a lot of liquidity in the market. And so frankly, the question is, how can Kenya, particularly in the region, continue to improve the ability of the private sector to anchor in? Because now we are getting more competitive in Africa generally trying to anchor in that, and particularly the sustainable finance type of money. What does the sector itself need to do? What does private sector in Kenya and in Africa need to do better to make sure that we're standing out and attracting the scale of capital that has that interest?
Sanda mentioned this in our comments, and I very much agree that there's a narrative challenge that we face. We have very good companies here, companies that can absorb the type of capital that becomes interesting for many investors. Many times I've heard that there aren't companies that can absorb $100, $200, $300, $500 million in private capital, but there are. I know many of them. So I think that's one. I think there's a narrative issue that we collectively need to work on in showcasing the types of companies that can absorb the type of capital that's ready to be put in the market. The second is I believe that there needs to be more conversations between the capital providers. So for example, we're working on national food security programs. There is a world in which we bring equity, debt, carbon, and subsidy to a government and ask the government to create an enabling environment for us to roll out a food security program. It would be interesting if those capital providers spoke to each other and came up with solutions that catalyze the market. So donors or subsidies or results-based financing facilities, all the same, can play an incredible role in catalyzing the public and private sector with government support. And there's this sort of coordination problem that we're playing as the private sector, and I'm not necessarily sure that we're the best person to coordinate that or the best entities, because it often comes off as salesy, that we're only doing it for ourselves, whereas we're trying to catalyze it for a sector. So I think there needs to be a sector leader, or there needs to be sort of a collaboration of funders, or someone to step up and coordinate the different types of capital because it's all there. It's just an allocation challenge. And I believe if we can figure out the allocation challenge, we can start seeing a lot more movement in Kenya.
Thank you. Thank you so much. And Eva, as you give your final comments, you look at the ecosystem. And so I really want to ask, what are the two ecosystems you think would make the most positive impact in private sector anchoring in sustainable finance? Samir has mentioned some of them, but you, from the venture capital point of view, what are the two ecosystems that changes you think would really shift things?
So the first one is a local one. And I'm passionate about building Africa for Africans. I represent all capital. I represent local capital and international capital. The bulk of my membership is foreign-raised capital being deployed here. And sadly, they may not have the nuances we have of doing business here. And there is a big, big gap that is yet to be filled by local capital providers. And I'm talking banks, pension, insurance, corporate institutions. Sanda talked about blended finance. It's a thing, and it needs to move from the development world, so the UN type of world, to be integrated and actualized in the corporate world, because that is the future. How do we blend local capital that understands the market, that can help de-risk in terms of currency risk, de-risk a project or an initiative like Samir has. We need those blended solutions. So that's the first ecosystem that I think is really pertinent. The second one is the PPP. So we traditionally think of PPPs from the context of infrastructure or government-involved projects. I would hope for an environment where, and FSD is enabling that, let me give you a shout out, right? An environment where we internalize that the government is not always the enemy. And the government, on the other side, realize that they are not in the business of building businesses. Their work is to facilitate. And like Samir said, there is room for all of us actors to sit around the same table collaboratively in addressing very public solutions, food, infrastructure development, and others, like building markets, and having government using their government means, whether it's policy, whether it's the AFCTA, whether it's the NIFC as an enabler and attractor of capital. There is a role for them to sit around the same table where we, private sector, are not always presenting problems to them. I think it can get even exhausting for them, but are also showcasing ourselves as partners for their own agenda. And then hopefully we have the entrepreneur there saying, this is what it will take for me to grow, and all of us actors just walk around together. So those are my two, local capital and PPP, away from infrastructure and integrated as a business strategy.
That's wonderful. And finally, Habil, I just want to sort of talk to you about something you had mentioned about the risks and the tools that you use to assess determining whether you're going to invest. It would really good to sort of finish, to sort of hear what is the banking sector doing in updating the way it assesses risk, the options it has in determining what to finance. How are those tools evolving? How are they changing? So that you, as the banking sector, can really deploy and tap into the opportunity that the sustainable finance world offers in Kenya and in the region.
Yeah, thank you. I think one area that I would like to highlight is we have got an e-learning platform, and we mentioned a little bit earlier about capacity building in the sector in order to promote sustainable finance. And under the Sustainable Finance Initiative, our initiative, we have got an e-learning platform, and we have got a number of modules in there. It's modular, so it can be scaled up with additional modules. And what we achieve through this is by building the capacity of the SMEs who are able to access this platform and basically get the skills. When you're talking about formalization, talking about building capacity in terms of trying to put some of a bankable proposal before a bank, they pick up quite a bit of the skills there. Now, recently we partnered with GIZ, and we introduced a new module that is trying to encourage green technology finance in the agriculture space, and this is trying to build their capacity to be able to apply the green technology in the agriculture sector, which is picked up quite a bit in terms of the kind of enthusiasm in accessing the module has so far shown. And our idea will therefore be that based on the lessons we learned from this, we will be, and the demand that we see in the market, we'll be able to build more modules that go towards enhancing the capability of the SMEs to be able to access credit from not just the banking sector, but I think from the formal credit providers. Let me say finance providers, because it can be credit, it can be mezzanine finance, it can be the various other options that can be. But I think the critical thing is to build their capacity to be able to put forward proposals that can then be bankable to providers of finance.
Thank you so much. I think this was a wonderfully engaging panel, and I thank you for your honesty, your foresight, and your candor. Thank you, Samir from SunCulture. Thank you to you, Eva from ABC, and thank you to you, Dr. Habil from the Kenya Bankers Association. I'll now welcome Collins, our communications lead, for the closing remarks.
Surely, my standing here means that we have come to an end of this brilliant event. And I will take a very short time to appreciate everyone who has contributed to making this event a success. And as I'm speaking here, I'm speaking on behalf of all of us at FSD Kenya. I'd like to sincerely to express our sincere gratitude to all of you who have made this event a success. Since 2015, as Tamara mentioned at the beginning of the event, we have curated these annual lectures to provide thought leadership and to stimulate debate on various financial sector development topics. This year's event, having listened to everything that has been discussed, right from the presentation by Sanda to the wonderful panel discussion, I have no doubt that we have achieved this. To our speaker, Assistant Secretary-General Sanda Ojiambo, asante sana for gracing this event, for your time, effort, and for sharing your brilliant insights. I also would like to thank your wonderful team at the United Nations Global Compact that has contributed in making that this event a success. To our wonderful panelists, Eva Warigia, Habil Olaka, Samir Ibrahim, thank you very much for agreeing to be part of our event this year. It's usually a very nerve-wracking, process to get wonderful people to synchronize their calendars and show up and contribute the way you have to this event. We thank you very much for being here. We couldn't have asked for a better panel for today's discussion. And Zetse, thank you very much for moderating today's discussion so masterfully. And COVID has shown us things that, one of our participants was joining from the other side of the world, but you have masterfully moderated today's conversation. To the entire FSD Kenya team, I know people here who've not slept for a few nights. They have worked late nights, early mornings. I appreciate the work that you guys have done to make today's event a success. And finally, and most importantly, I'd like to thank everyone who has taken their time to attend this year's event and to engage online. This event would not be a success if you did not heed our call to register and to attend the 8th FSD Kenya Annual Lecture. Thank you for being with us. Thank you all, and see you again next year.